Hey everyone, welcome back to Corporate Decoder. Today, Morgan Stanley Direct Lending Fund MSDL just filed a Form 8K, and I am seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just announced a massive debt offering, and while it seems like a positive move, there is an important detail to consider. Morgan Stanley Direct Lending Fund, which we know as MSDL, announced on the 29th of June 2026 that they entered into an underwriting agreement. This is basically a deal to sell new debt. They are planning to issue and sell $350 million worth of new notes. These notes are going to mature in 2031 and will carry an interest rate of 6.100%. So why is this significant? Well, a $350 million debt sale is a pretty big transaction for any company, especially for a fund like this. This is essentially borrowing a large sum of money. The company states that this offering is being made to repay secured borrowings. This suggests they are looking to manage their existing debt and potentially get better terms or simplify their financial structure. This offering is being done under a pre-approved plan filed with the Securities and Exchange Commission, known as a shelf registration. This means they had already told investors they might sell more securities, and now they are executing that plan. It also involved a preliminary prospectus supplement, a term sheet, and a final prospectus supplement, all dated the 29th of June. These documents lay out the details of the offering for potential investors. The underwriting agreement itself includes standard clauses. Think of it as a contract between the company, its manager, Mississippi Capital Partners Advisor Incorporated, and the underwriters. The underwriters are essentially the banks that help sell these new notes to investors. The agreement covers usual terms like representations, warranties, and covenants, which are promises the company makes. It also includes indemnification clauses, meaning the company, its advisor, and the underwriters agree to protect each other against certain potential liabilities. Now, let's bring in some external context. Morgan Stanley Direct Lending Fund is a company in the financial services and asset management sector. Its market capitalization is around $1.3 billion with a price-to-earnings ratio of about 15.1. The current stock price is around $15.25. They have major institutional holders like Morgan Stanley itself, which owns a significant chunk, about 18.7%. Other holders include Generali Asset Management and UBS Group. This kind of debt issuance is common for funds like MSDL as they manage and grow their investment portfolios. The crucial detail here is the interest rate. 6.100% on $350 million is a substantial annual interest payment. This needs to be managed effectively, and the purpose of repaying secured borrowings is strategic. It shows a push towards potentially lowering their overall cost of capital, or perhaps refinancing debt that was coming due. Looking at the bigger picture, this move by MSDL is about managing their balance sheet. They are raising capital, not for expansion in terms of new business lines, but to refinance existing obligations. This can be a sign of financial maturity, optimizing their debt structure. However, it also means they are committed to paying these new interest expenses for the next decade, until 2031, for investors in MSDL. This means understanding how this new debt impacts the fund's overall profitability and its ability to distribute income. While it provides liquidity and potentially better debt terms, it also adds to the fixed financial obligations. We need to watch how effectively they deploy this capital and manage the associated interest costs. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please hit like and subscribe for more and join our Discord community in the description.